Home sales figures and reports in the United States have recently been released, and the data has been truly worrying. The figures show how single-family home sales experienced their worst decline in the last 3 years in May. This collapse in sales has also driven housing inventories to record highs, leading, for now, to a drop in the stock prices of construction companies. If total new home sales are taken into account, there's a 13.7% drop on a seasonally adjusted basis, the lowest figure in the last 7 months, according to data from the Department of Commerce. But on the other hand, prices continue to rise, and the average home value in the United States is around $400,000. With this information, it is worth analyzing the causes of this drop in home sales and whether we may already be in a housing price bubble in North America. Let's start by reviewing the main causes of the tremendous drop in home sales. The first reason for the collapse in new home sales is the high interest rates on home purchase mortgages. Due to the Fed's rate hike in 2022, interest rates have increased significantly, as mortgage rates went from below 3% in 2022 to rates close to 7% currently. These high rates mean that when people finance their home purchases, the monthly payment is very high, especially considering the high real estate prices. Therefore, many people prefer to postpone their home purchases, waiting for interest rates to begin to drop. The second cause of the decline in home sales is related to high prices. As seen in the images, the housing market in the United States has experienced a cycle of sustained price growth since 2012. If housing prices are taken into account in 2012, prices have more than doubled. This prevents many people from meeting the income requirements for home ownership. Considering 2020 prices, real estate prices have risen by nearly 50%, which is an average annual price increase of 10%. The problem is that the average income of American families has not grown at the same rate. According to data from the Federal Reserve Bank of St. Louis, the average family income in the United States rose from $65,000 in 2012 to nearly $80,000 in 2023. But what's even more difficult for home ownership is that the average salary between 2020 and 2025 has increased much less than the increase in housing prices, which, as we've already reviewed, has been 50% in the last 5 years. Therefore, two factors limit home ownership: high prices and high mortgage rates. The consequence is that the average monthly mortgage payment for a family has increased by 6.6% in the last year, reaching an average monthly payment of $2,144, one of the payments that has increased the most in percentage terms. The increase in monthly mortgage payments has led to an increasingly larger percentage of families' monthly income being used to pay their mortgages, reaching over 33% of monthly income to cover the bank obligation. This table shows how in 2011, the average cost of a home in the United States was $225,000, with mortgage rates averaging 4.6%. Under these conditions, households had an average monthly mortgage payment of $927, while by 2024, the average home value was $419,000, but the mortgage interest rate was close to 7%. This means an average monthly mortgage payment of $2,207. While not adjusted for inflation, this figure does reflect an increase in mortgage payments that exceeds wage increases. And it has been especially in recent years with the rise in interest rates where the situation has been most critical, because as we see in the image, due to the increase in mortgage rates, the value of the monthly payment increased by 50%, leading to the accumulated interest payment projected over 30 years increasing by more than 100%. But the housing crisis also has other components. Uncertainty has increased in recent months because people are more afraid of losing their jobs. While the overall unemployment rate has risen slightly so far, it is clear that the unemployment rate among recent graduates has risen sharply, indicating that the labor market is not doing well, as it is possible that not enough jobs are being created. Another reason for the increased uncertainty has been news about the state of the economy. It was recently reported that first quarter economic growth in the United States was negative, with a 0.5% drop, a situation that often creates a negative environment for investment and home buying. As if that were not enough, the increase in economic and political uncertainty in recent months, largely generated by the so-called trade war, where President Trump's announcement of increased tariffs on a large number of imported products also lead people to expect higher prices. Although a truce has been observed in the so-called trade war, the tariffs that will ultimately be imposed on imported products are still unclear. For now, inflation has been declining, but the impact of tariffs on inflation cannot be ruled out. This is one of the reasons why there is still no clarity regarding the Federal Reserve's decision to reduce benchmark rates, which would also allow mortgage rates to gradually decrease. For now, the market expects the long-awaited start of the Federal Reserve's benchmark rate reduction cycle to take place in September. In fact, President Trump has sent various messages on several occasions to try to get the Fed to make the decision to cut rates. But on the other hand, Jerome Powell, chairman of the Fed, has sent messages of caution, stating that the Federal Reserve was not eager to reduce rates and that it was important to monitor the impact of tariffs on inflation. This uncertainty has likely been one of the reasons why people have postponed home purchases. Additionally, home prices have also increased because some of the materials used in their construction are imported. And the increase in prices due to tariffs has also hurt construction companies, which sold homes with input prices below current prices. It is estimated that 7% of construction materials are imported. The recent record of housing inventories has led to housing prices already showing a correction in some cities. For example, in San Francisco and Austin, the average home price has even fallen in recent months. But other cities have also seen significant drops in home prices, such as Oakland, Jacksonville, and Dallas. This situation is largely due to the fact that the average time to sell a home is 51 days, 6 days longer than the time required a year ago. For now, not everything is negative. Although the non-performing loan portfolio has recently increased, it is currently close to 1%, levels that show that people can afford to pay their mortgages without any problems. However, it is not so simple to try to establish possible scenarios for the future real estate market. On the one hand, there is a negative scenario where a recession in the United States could lead to a rise in the unemployment rate. This situation would lead to an increase in the non-performing loan portfolio and a collapse in prices due to the large number of foreclosed homes. For now, this scenario is unlikely, as recent figures from the Atlanta Federal Reserve show that the economy has managed to recover in the second quarter. But of course, these figures are preliminary, and much information is needed to consolidate the GDP growth that will actually occur in the second quarter. Another likely scenario would be somewhat negative, with an economy experiencing low growth, close to 1%, and where the long-awaited Federal Reserve rate cut for September is not achieved. In this scenario, sales are likely to continue their stagnant trend, leading to slight price declines. But it's also possible that the Federal Reserve will ultimately cut rates in September due to controlled inflation. In this scenario, prices may continue to rise. However, depending on the economic recovery, this would lead to a rise in home values at a greater or lesser rate. Of course, as we've already analyzed, the cycle of rising prices have been going on for quite some time, and a slight correction in the real estate market will be positive, allowing more people to purchase homes under favorable conditions, rather than forcing them to take out loans with conditions that imply debts that could become unpayable. Finally, every crisis has opportunities, and currently, the most important construction companies have seen their stock prices drop by more than 30%. Although this is not the main topic of this video, it would be worthwhile to review the current situation and fundamentals of the sector in more depth to try to assess whether this represents an investment opportunity. In any case, it's important to keep an eye on the real estate market, as an excessive increase in housing prices due to lower interest rates could lead to a price bubble with consequences already seen in the past. Remember that in the video description, you'll find a link to the best course for learning technical and fundamental analysis for investing in stocks. There's also a link to the best platform for buying stocks on the stock exchange, regulated in the United States. If you enjoyed the video, give us a like, subscribe to the channel, and share the content.